Ooh, okay, thank you. Maglatse, Amapiano is a genre, not a song. Ooh, what is it? I'm sure there is a song that says, never mind. Okay, so it's a genre. Thank you. You learn something new every day, and I always want to learn something new. Yeah, okay. Before I get philosophical, we've got a full lecture today, so I will leave my preaching for another day. So today we're doing lecture 2 of IFRS 60 leases, and we are still looking at the lessee. We'll be finishing with the lessee today, and then from next week after your CV, we will be looking at the lessor. Okay, so included in the scope of the CV is everything up until today's lecture, everything we've done, IAS 12 and IFRS 16 lessee. So not that much work. If you've been working consistently, then you should not be too stressed about Monday's test. Okay, and relax about it. Don't worry too much about it. No one fails FRK 300 with CEV1, and no one passes FRK 300 with CEV1. So that's just the CVs are just there to give you an opportunity to test yourself to see, okay, how comfortable am I with these topics? Okay, so relax about it, study hard for it, but remember, you're not just studying for the CV, and you're not just studying for the year test, and you're not just studying for the exam. You are actually studying for a career, for a profession. So that's the way you should approach your studies. Don't just think about passing the test. Think about the knowledge that you need, that you're going to need one day in the profession. Okay, good. So we'll start with lecture 2 today. Okay, Ms. Kolokoto, I hope you're not laughing at me. That is very rude. I've got a small heart and I get hurt very easily. So I hope you're laughing at some joke or something. Good, let's start. Okay, so first of all, some administration. You should all now be happy and comfortable with the CV that's happening on Monday. We had the information session yesterday, so all of those questions should be answered by now. So I just want to share with you the class representatives. So here are our class representatives. Thank you to them for being willing to act as class representatives. Mr. Armstrong. Okay, so thank you to Derek, Bianca, and Rwanda for being willing to act as class representatives. How the process worked was I asked you guys for nominations. Then I selected all the students who received the most nominations. So I had a list of students who received the most nominations. And then I emailed them to ask them who of them are willing to act as class representatives. And some of them decided they are not willing to act as class representatives. In the end, we received these 3 names. So it is quite a big responsibility, and I'm very grateful to the 3 of them for being willing to do that. And I completely understand the others of you decided that this is actually not what you want to do. Okay, so the contact details, names, and everything is are available. Names are available on ClickUp under the admin tab. So if you have any issues that you feel is something that should be addressed by the class reps, then please contact them. Remember, that's how the process works. You first go to the class rep. If you're unhappy about something, the class rep comes and speaks to us. And then if you guys are still not happy, then the class rep will go and speak to our head of department. And then the class rep will go, if the class rep is still not happy, then they can start going to the Deputy Dean of Teaching and Learning. So don't just jump and email Prof. Lutz, our Dean, if you have an issue with me. Let's go through the proper channels. And we are always willing to listen to what the issues that you have and the problems that you have. We're always willing to help. So yeah, so please use the class reps, otherwise come speak to us directly and we'll sort everything out. Good, okay, so that's the class reps. Now I asked you for today's lecture to have a look at example 7. So example 7 gives us a little bit, some additional information from the information that we had in class example 1. And then we are asked to, I can't remember what we asked to do the tax. I can't remember. But anyway, the purpose of this example is to illustrate the tax for the lessee. Okay, so I just quickly want to run through example 7, just to make sure that that you are on top of the tax treatment, and then we'll look at the reassessments. Okay, Mr. Schrempel, studying for all 4 modules can be rather cruel at times. Oh, I love myself an accounting pun. Thank you. Yeah, that's I can understand that. Okay, but don't suffer from depreciation because of that. Okay, get yourself positive and excited about the CV. Okay, I can barely account for it. Oh, you guys are so clever. Okay, good. So in class example 7, we had our lease liability. We measured that lease liability in class example 1, and then we used that to measure the right of use asset. And then what I'm giving you here is I'm just giving you the year 1's, the first line from my amortization table. So this is my outstanding, or my initial measurement of the lease. And then we have the first payment. The payment consists of an interest portion and a capital portion. Okay, and there's our right of use asset, plus everything that we added to that. And then we also have our depreciation for year 1. So this will be our carrying amount at the end of the year for the right of use asset. And this is my carrying amount at the end of the year for my lease liability. Good. However, remember that we had, so our minimum lease payments was 3,050,000. So that was an in-substance fixed payment. However, we actually paid, in 2016 we paid that amount, but in 2017 we had to pay an additional amount because of the fact that we made more units. Okay, so the difference then between the minimum amount and the amount we paid will be a variable lease payment, which we will just expense. Okay, then we also had some short-term leases. So in example 7, they give us more information on the short-term leases, on the low-value asset lease. So there, what we had is we paid a certain amount for the first year, and then a different amount the second year, and a different amount in the third year, and we had to straight line those payments. So for 2016, we actually paid 18,000, so that was the actual cash that we paid. However, the accounting is the smoothing of the accounting expense, or the straight line accounting expense was 2,500 per month for 6 months. So this was my accounting expense, and that gives us an amount that was paid in advance of 3,000 Rand. Okay, so let's just quickly check. I see some questions. Ma'am, could you please just mention what the rule is again if the interest payments and contract do not coincide? Okay, so you are talking about the situation where if this is my reporting year, so we like we have in this example, 31 December 2016 was my reporting year. And then, for example, let's say we entered into the lease over here on the 1st of April. Okay, so that means that my lease year is only going to end over here. Okay, so that's my lease year on the 31st of March in the next year. So what's going to happen if this is the case? Then I am going to calculate, because now remember we have to, on the 31st of December, we have to do our statements of financial position. So what we will do is we will calculate, we will ask our calculator what the amort, whatever year this is, lease year it is, and we'll ask the calculator what the balance is on this day. Okay, so let's say the lease started in the prior year, so then it will be amort 1 balance, and that will give us the outstanding balance on this date. And then we'll say, okay, but now remember, there are 9 months for which we have to accrue interest. So what we'll do is we'll go and ask our calculators, amort to interest. We'll ask our calculators what that amount is, and that amount we are going to multiply with 9/12, okay, for these 9 months that are still within my reporting date. And then to calculate my closing balance on this day, I'm going to take my outstanding balance that I calculated over here, plus the accrued interest that we calculated over there. And that gives us then the closing balance on this date. Okay, Ms. Lewis, does that answer your question? Good. Ma'am, on initial measurement, why do we not split it already between short and long term? For example, if we get a lease at the start of the year. Okay, remember splitting a liability between short term and the short term and the long term. Current liability and non-current liability, the short and the non-current part. That's just something that we do for presentation purposes. So we never have a we'll never have a well, we will have a journal to take it to that short-term portion, but we only do that for presentation purposes. So we'll only do that at the end of the year when we have that when it's our financial year. So usually, if I think about it now, my daughter's now matric and she has accounting, and I know they actually do a journal. But usually we don't do journals for that. It's just something that we do for presentation purposes. So I think that will be more like almost part of your closing journals that you do, maybe. But it doesn't matter. So we keep it. We keep everything in my lease liability account, and then when we present it on the SFP, we will just split it between the current and the non-current portions. Okay. Oh gosh, you guys are. This is not a consulting session. This is a lecture. When it is likely that the lessee with a purchase option after the end of the lease term, is the purchase option amount included in the future value of the interest rate calculated? Okay. Let's quickly go back. So what you are asking me, okay, Mr. Ms. Perumal, can we maybe just park that question and get back to it at the end if we have time? Because otherwise I'm just not going to get through today's lecture. And yeah, and it's important that I do. So because that is more a consultation question than actually a question on the specific work that we're doing. But I will probably address it when we look at our calculations later on. Okay, so if by the end of the session you're still unsure, then please just repost your question, or just remind me about your question about the purchase option and the interest rate, and then we'll address that. Good. Okay. On initial, we're not supposed to, okay, ask that one. Thank you. If they didn't give us a minimum amount that has to be paid in this case, then would the full amount be variable? Yes, because it's variable and it's not linked to an index or a rate. So therefore, it is not part of the lease payment definition, and therefore it will just be expense. Okay. Okay, thanks. Just wondered. Thank you so much. Cool. Okay. Good. Okay. So let's Ms. Perumal, remember about that question. Good. Okay, so that's all the information that we have in class example 7. And now we have to do the tax. So remember when we do the tax, they told us in the question that the lease incentive that we received was taxable when we received it. But remember, it's included in the carrying amount of the asset. So for accounting purposes, it's going to be expensed as part of the depreciation over the useful life of this asset. Initial direct costs were deducted when paid. So same situation as the lease incentive. Lease incentive is not going to be deducted. It's just going to make my depreciation expense smaller. And then the deposit paid, also deducted when paid in the current year. Sorry. And then lastly, the restoration provision is going to be deducted when it's paid, but that's only going to be paid in future when we actually have to do the restoration. Good. So that's the information that they gave us for example 7. So now we have to calculate the current tax expense. Now I realize this is small, but you do have the example with you in your notes. So I will just quickly talk you through it. So we start off with our accounting profit before tax that they gave us. There was a dividend income that we have to deduct because we don't have to pay tax on that. And then we start off with our temporary differences, first of all, for our factory building. So here we have to add back the depreciation and the finance cost. So the depreciation was on the right of use asset, and the finance cost was on the lease liability, was cost from the lease liability. We add that back because the receiver does not see it as my asset and a liability on which I am paying interest. What I do get as a deduction for tax purposes is I get the full amount that I paid as a lease payment as a deduction. And we also have the deposit, the initial direct costs, and then the lease incentive received that we are taxed on. Good. So that's for the factory building. For the short-term leases, you will see that there's actually no difference between the accounting and the tax expense. Remember, now I know for BEL 300, you have to show the in and the out, or I know that they work that way, but for us, you don't have to. So for us, you actually don't have to show this plus 125,400, less 125,400. We will, if someone adds only one of those lines, just do the deduction instead of adding it back as well, then we will negative mark that. But if there's no effect, you don't have to show. Okay, and then for our low value lease, we have a little bit of a problem now because the expense that we have included for accounting purposes was 15,000, but the amount that we actually paid was 18,000. So there's a little bit of a temporary difference. So these two lines you have to show, but these you can just leave that out. Okay, and then we also had an interest expense for that restoration cost, provision for restoration costs, which the receiver will not recognize. They will give us the full amount of the deduction of the restoration costs in the future as a deduction. Okay, so, and then this is our taxable profit, and we take that, multiply that 28%, and that's the current tax expense. Good, now we do the same for 2017, so that was for 2016 that we just looked at. Now for 2017, the calcs are exactly the same, except now obviously we don't have the deposit, the initial direct costs, and the lease incentive. So that all happened in 2016, so that's missing in 2017. And also, oh yes, I want to quickly show you just the low value assets. So there's our low value assets over here. So we have our lease expense, which was the accounting expense that we add back, and then the tax deductions, the actual cash that we paid. So remember those low value assets, we calculate what the total lease payments are going to be over the lease term, and then we divide it by the years or the amount of months, and that gives us an expense per month. Now the problem here is we have a situation where this is our financial year, and we actually entered into this lease in the middle of the year. So we had 6 months of the first lease payments in our first financial year, and then in our next financial year we would have the other 6 months over here, as well as in 6 months of the next lease year, and so on and so forth. Good. So the lease year works like this in this example. Okay, so if I look at 2016, as we said, for accounting purposes, we are going to, for every year, we are going to have the straight line expense. So we had 6 months in 2016, a year, and then 6 months in 2019. But for tax purposes, we get a deduction of the actual amount that we paid. So that was 18,000 for year one. So because it was 3,000 times 6 months. Then for the next year, it was the 3,000 again for 6 months. As well as the 2,500, that 2,500 for the next 6 months, and so on and so forth until we get to the end. So what you should see here is that in 2016, we actually have we'll have an accounting prepayment of 3,000. Then in the next year, we have an additional prepayment of 3,000, meaning at the end of 2017, we actually have a prepaid expense of 6,000. Okay, and then it goes, the next year we are going to have, make use of that prepayment, as well as then in 2019, so that in the end, everything works out. Okay, so before we go to the deferred tax, I'll quickly check the questions. Please explain the interest on the restoration provision. Okay, so they gave us an interest rate, rate that we are going to use. Remember that these rates are always going to be the before tax rates. So sometimes we might see an after tax rate, but that we never use after tax rates. We always use before tax rates, because remember, your provision or this restoration provision, your assets and all of that, that's always going to be pre-tax amount. Your SFP, we have everything is pre-tax, and then we have our tax consequences, a deferred tax as a separate line. So therefore, we use the before tax rates. Good. So, but you're asking, how does this restoration provision work? So we are saying that in future we are going to pay 2.5 million as for restoration costs, and that is over 15 years. In 15 years from now, we're going to have pay that restoration costs. They give us a rate that we must use, and then we calculate what our present value is. So effectively what happens here is we now have the 427,000 is the present value today, and then in future, now I can't remember what that amount was, 2.5, 1.5. So in 15 years time, we are going to have, I can't remember, what was it, 2.5 million? Oh, I have to check. Yeah, 2.5, okay. Okay, so 427,000 now, and 2.5 million in 15 years time. Hendrik, who helps us with our IT, just walked in with chips and Coke and nothing for me. So I think it's very rude to eat in front of someone else, especially when they haven't had breakfast yet. Okay, so what's going to happen? So this is what we recognize our liability or the provision for on day one. But in 15 years' time, I'm going to pay 2.5 million rand. So what's going to happen with this provision is we start off with a 427,000, and then every year this provision is going to grow with my interest. So every year this provision is going to grow and grow and grow and grow until at the end of 15 years it gets to 2.5 million. So in year one, when I recognize my provision, I'm going to say, okay, the expense is 427,000. Because that's the present value of that expense. Now this provision is going to grow, 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 and in the end, this balance here is going to sit at 2.5 million. This balance is going to sit at 2.5 million. And then when we pay the provision, we're just going to say credit bank, debit the provision to clear it out. Okay, so that's how that works. So I hope I answered your question there on the provision. Okay, you get deduction for interest expense because SARS will allow you to deduct the future value when it becomes due is incurred. Otherwise, you would be deducted twice. Are we not talking about, Rudolph, you're answering a question that I missed. Sorry if I missed your question. Okay, so you also missed Ms. McNamara's question, but I think someone answered you. So they didn't give us a minimum. Yeah, no, I answered your question there, so that's fine. Okay, Ms. Luvengo, if you're still unsure, then just okay. Seems like Mr. Swanepoel answered your question there. Thank you for that. Are we allowed to show net item for the low value asset as a prepaid expense in the current tax calc? Yes, you can do that. So you can show the net amount. So you are asking if you can just do the net amount there. But remember, yeah, it's just a little bit risky. I would rather, it's always better, I think, to first go and say reverse the accounting, then put in the tax treatment. Okay, but if you just show it as a net amount, then that's fine. Then just please have a proper calculation and a cross-reference so that the marker knows where to go and find the marks for you if your amount is not correct. Okay, what would happen for the low value asset? The lease expense is more than the lease payments paid in cash. Okay, then it's just going to be, instead of a prepaid expense, it's going to be an accrued expense. Because then we are going to have a situation where, for accounting purposes, for example, our expense was 15,000, but our cash amount that we paid was only 10,000. So then that means we have a so we'll have debit the expense with 15, credit bank with 10. So we need another credit. So that's going to be an accrued expense, yes. Okay, 5,000. Good. Okay, Hendrik, they agree with me that you are rude, not to buy some sweets for me. Morning coffee needed, I agree. Okay, then they are just chatting and making jokes and okay, so we can carry on. Good. Okay, so now we look at the current tax. Now let's quickly look at the deferred tax. So for the deferred tax, we list all our carrying amounts. So this is the 2016 deferred tax count. So here we have our carrying amount for the right of use asset and our carrying amount for the lease liability. We have an amount paid in advance. So okay, and then short-term leases won't have a SFP balance. So the only thing there is the restoration provision, which is the 427,500 to be recognized on day one, plus the first year's interest that now is going to make that provision bigger and bigger and bigger until in the end when it gets to 2.5 million. So that's the balance of the restoration provision. Good. So now we have to look at the tax basis. Good. So first of all, my right of use asset. Now you'll see in the notes, you'll see in this little note A for the right of use asset tax. Oh, it's not note A, it's note B. Okay, so note B, sorry, for the right of use asset tax-based discussion. You will see that we give an explanation to say that this right of use asset carrying amount actually consists of two things with different tax treatments. So we have the initial direct cost, and then we have the rest of my right of use asset. Now, the reason why my tax base is 0 is actually different for these two components or these two portions of the carrying amount of the right of use asset. So for the initial direct cost, the tax base will be 0 because of the fact that the initial direct costs have already been deducted in the current year. Okay, so that's why for that portion, the tax base will be 0. Nothing is deductible in future anymore because we received a deduction for the initial direct cost in the first year. However, for the rest of that asset, the deduction will be 0 because we are not going to get any future deductions. Okay, so you don't have to split that up, but just know I could ask you a discussion question to say, discuss what the tax base of the right of use asset should be. And then you'll need to know. You can't just say there won't be any deductions in future, because for the initial direct cost, we actually did have a deduction in the current year. That's why the tax base is 0. Okay, but for a calculation question, don't worry about it. You just say right of use asset. You know that the tax base is 0, so you put that in as a 0. Good. Okay, and then for the so no deduction, we don't get any wear and tear or anything like that on the right of use asset. So tax base will be 0, but for the lease liability, we are actually going to get deductions because as we pay our lease payments, there will be a capital portion in that lease payment, and that capital portion will be part of the lease payment that I'm getting as a deduction when I pay it for tax purposes. So therefore, the lease liability tax base is carrying amount less deductions in future, and therefore the tax base is 0. Okay, we've got our prepaid expense. So the prepaid expense is, again, the tax base will be 0 because we've already received that amount as a deduction for tax purposes, but we're only going to have it as an expense for accounting purposes actually in 2 years' time. Okay, and then the restoration provision. So here it's a liability. So the tax base is the carrying amount less the deductions in future, and that carrying amount is part of the 2.5 million that I'm going to get as a deduction in future. Therefore, the 480 carrying amount less 480 that I'm going to get as a deduction in future gives me a 0 tax base. Okay. Okay, Ms. Lewis asked, please repeat why the tax base for the right of use asset is 0. Okay, because for the right of use asset, I'm not going to remember the receiver does not see this as an asset that I'm getting. The receiver says, but wait a minute, this asset is still the lessor's asset. So you cannot get any wear and tear allowances on that asset. Okay, so yes, as Mr. Armstrong said. So we don't get that wear and tear on that. There's no deductions that we get for tax purposes. Okay, will there be any difference in the tax base of right of use asset if ownership is transferred at the end of the lease term? No, still not, because you are not going to get any tax deductions for the right of use asset. When that asset now becomes mine at the end of the lease term, interesting question. Interesting question. Ms. van Viljoen, I'm going to have to think about that one. So therefore, you know, it's not in Monday's test. Interesting question. Never mind. Okay. So, okay, tax allowances on the right of use asset cannot be claimed. Initial cost and lease payments as initial made already done. So it's transferred. Do we then treat the asset as usual asset? No, still not. Even if the asset is transferred during the period of the lease term, the asset is not mine. I just have a right to use the asset. So there's a difference between having a right of use asset and having an actual asset. So for an actual asset, I have the ownership rights to my asset. Here, I only have the right to use the asset. So that's my asset that I'm recognizing. Okay, so no, we will not get that. We will not get that any tax allowances for that right of use asset. Good. So on this is something that yeah. So remember on Tuesday, one of you asked about the tax base temporary difference deferred tax. If we say the right of use asset, and we have a carrying amount over here. Then, and we're not going to get any deductions in future, so therefore we have a temporary difference on day one. And the question was now, well, should this not be exempt? Okay, so I just want to reiterate what I said on Tuesday. So this is something like I told you, we actually we use the formulas just to help us. If we think about it, then we know that there should be we should have a deferred tax, and we should have a temporary differences on this right of use asset. But now when we apply the formulas and the standard, then we see that now it seems as if we should that amount should be exempt. Now there's actually something specific. They are going to actually update IAS 12 because of my leases and this right of use asset initial recognition. And what they are saying is, because of the fact that we are at the same date recognizing a lease liability, which is going to be, if my right of use asset on day one is 100 Rand, my lease liability on day one is also going to be 100 Rand. Remember, that's the starting point for my right of use asset calculation. And that and the lease liabilities tax base is going to be 100 less 100, because I'm going to get the full deduction in future. So therefore, tax base will be 0 on day one, giving me a deductible temporary difference of 100. And then what IAS 12 is going to be updated to say now is that because of the fact that for this transaction, there's no temporary difference on day one, the exemption does not apply. Okay, so we have to look at that transaction in its in entirety on day one to decide if the exemption applies or not. Goed. Okay, so that's the deferred tax. Are you happy with that? Oh, Mr. Rio, thank you. He says, Ms. van Biljon asked the same question in the discussion board. Mr. Badenhorst answered it in detail. Okay. Good. Thank you to Mr. Badenhorst. Dr. Badenhorst, by the way, although he would not mind it if we call him Mr. He doesn't have a... Good. So that's just the deferred tax for 2017. And now you'll see here our prepaid lease expense was 3,000. We're now in 2017. It now grew to 6,000. Oh my word! I hope I don't have to read all of that. Okay, thank you, Jamie, for that. Please read it after the lecture. Okay, not during our lecture today. Okay, so I just want to, I've decided to just quickly stop the recording for a second here so that we have shorter videos to make it easier to download. So I just want to quickly stop.